What if the real problem is not that this market is irrational? What if the real problem is that it has trained people to trust irrationality? That is the question I keep returning to, because a dangerous market does not become truly dangerous the moment it gets expensive. It becomes truly dangerous when enough people stop caring that it is expensive. That is the phase I think we are in. The market has not merely remained elevated, it has trained the crowd to see elevation as ordinary. It has trained them to treat every warning as something temporary, every strain as something absorbable, every delayed correction as proof that the old rules no longer apply. That is not strength. That is the psychology of a late bubble. The public wants a simple story. It always does. If the market has not crashed yet, then maybe the danger is exaggerated. That line sounds reasonable. It is one of the most expensive lies investors tell themselves. The market can remain irrational for a long time, but the cost of that irrationality changes during the delay. Leverage rises, complacency rises, narratives harden, respect for valuation erodes. The eventual adjustment becomes larger because the market has spent more time training people into the wrong behavior. That is why I do not think of delay as dead time. I think of delay as active risk accumulation. Now, let us make the risk visible. Start with the most obvious thing. The market is still expensive, not mildly expensive, not mildly optimistic. Expensive in the sense that investors are paying as though the future must cooperate unusually well for unusually long. The Buffett indicator sits in territory that would have caused serious discomfort in earlier eras. Broad market multiples are high. The most admired companies trade at valuations that demand remarkable execution with very little room for disappointment. Those are facts. The public hears them and shrugs because the market is still up. That shrug is the danger. A market can ignore valuation for a while. That does not mean valuation is irrelevant. It means confidence is still doing the work that discipline should have done earlier. And confidence can leave faster than people think. The next question is, what is feeding that confidence? I do not think it is one thing. I think it is a layered structure of supports. Deficit spending, inflation, flattered earnings, weak dollar effects, debt-supported consumption, lagging labor weakness, and perhaps most powerful of all, the crowd's belief that rescue is still the natural end to every stressful chapter. Let us begin with deficits. A government spending far more than it collects is not simply running an embarrassing spreadsheet. It is directly affecting economic conditions. The extra money moves through contractors, wages, subsidies, defense, industrial policy, infrastructure, and every corner touched by public spending. That keeps nominal activity warmer than it otherwise would be. If nominal activity remains warm, earnings remain respectable enough to keep the market's narrative alive. This does not mean the private economy is sound. It means support is large enough to mask some of the weakness. Masking is not healing. This is why I have so little patience for the phrase resilient economy when it is used without reference to deficits. If the state is spending massively in excess of what it collects, some of what people call resilience may be deficit, purchased endurance. That endurance can last for a while. It comes with a debt bill, around $38 trillion of debt and interest costs, above $1 trillion a year, are not the backdrop of a genuinely clean system. They are the backdrop of a system buying time at an increasingly visible price. Then comes inflation. The public experiences inflation as damage. The market often experiences inflation as camouflage. That is an ugly but important truth. As prices rise, revenues can rise, earnings can still look good enough. Nominal growth can continue supporting optimistic narratives, even if real quality is deteriorating. Investors then behave as though the companies are proving strength. Sometimes they are. Sometimes they are simply being carried by a weak measuring stick. This is why I dislike casual discussions of growth in inflationary environments. The first question should always be whether the growth is real or partly monetary. If the market stops asking that question, it starts paying for mirages. A weaker dollar only deepens the same distortion. Assets quoted in weaker dollars can still look powerful even while the currency underneath them is losing force. The public feels the cost of that through daily life. The market sees the nominal result and calls it strength. This split between lived reality and market optics is one reason the crowd becomes so confused in late cycles. People say, how can the market still act this way when ordinary life feels so strained? It can act that way because the people setting prices are not reading only household pain. They are reading support, liquidity, nominal earnings, and the persistence of belief. That does not make the market right. It makes the market temporarily supportable. The consumer is another place where temporary support is being misunderstood. People say the consumer is resilient because spending continues. I say the consumer may be spending because debt and habit are delaying recognition. Those are very different things. A household can still act normal long after its balance sheet has become abnormal. That is one of the oldest patterns in economic life. People do not lower their standard of living easily. They borrow, they postpone. They maintain appearances. They tell themselves the next raise or the next easier year will restore the old comfort. Meanwhile, the debt rises, the stress rises. The hidden weakness deepens. The market sees receipts. I want to see the balance sheet behind the receipts. If demand is debt financed, I do not call it durable demand, I call it borrowed time. The labor market then adds another layer of false comfort. Employment is always emotionally persuasive because jobs still look like proof of normality. But labor is a lagging variable. That should be repeated until people stop pretending otherwise. A labor market can remain backward, looking, while other parts of the system are already weakening. That is why a still acceptable labor market reading does not calm me very much. In a market this expensive, it may mean the pain has not fully transmitted. It does not mean the pain is absent. Then there is policy faith. This may be the most seductive support of all. The market has been conditioned by prior cycles to believe that real trouble always summons enough help. That belief has survived long enough to become instinct. Weakness appears, policy responds, prices recover. Repeat the sequence enough times, and investors stop seeing it as a conditional pattern, they start seeing it as the way the world works. That is how moral hazard becomes emotional. And moral hazard becomes especially dangerous when it sits beneath a very expensive market, because then you no longer need merely strong fundamentals. You need fundamentals strong enough to justify the price, and confidence strong enough to keep supporting the belief that rescue will always arrive. That is a heavy burden. The public is carrying that burden much too casually. This is why I think the final phase of a dangerous market is always a phase of memory corruption. People remember the survival. They forget the cost of the survival. They remember that the market kept climbing. They forget that the climb depended on supports that were expensive, politically contingent, and vulnerable to fading. They remember that bad news did not matter. They forget that bad news did not matter only because confidence had not yet broken. That is the corruption. It turns delay into doctrine, then doctrine into faith, then faith into fragility. Because once faith is doing the heavy lifting, the market becomes much more dependent on the absence of surprise than people understand. A market held up by strong fundamentals can absorb disappointment. A market held up by confidence in delayed pain cannot absorb much before it begins to wobble. That is why I say confidence is the last bolt. By the time valuations are this high, by the time the supports are this layered, and by the time the public has grown this accustomed to survival, the final thing holding the structure together is not purely earnings or GDP or jobs. It is belief. Belief that the supports will keep doing their work. Belief that bad news will remain manageable. Belief that rescue will arrive if conditions become too unstable. Belief that the expensive price being paid today will look reasonable tomorrow. That is a lot to ask from belief. And once a market asks too much from belief, it becomes more fragile than it looks. The trigger can be almost anything. The point is not the trigger. The point is how much trust is being asked to absorb it. That is why I do not waste much time trying to guess the exact event. A credit fracture, a sharp earnings disappointment, a consumer slowdown, a policy error, a funding shock, a company everyone trusted suddenly showing weakness. Any of these can matter if confidence is thin enough. The trigger only reveals what the delay had been hiding. This is why I become more cautious, not less cautious, when the market keeps surviving obvious warning signs. Every survival trains the crowd into deeper bad habits. They stop demanding value. They stop demanding safety. They stop respecting arithmetic. Then, when the break comes, it feels like betrayal. It was never betrayal. It was delayed recognition. I prefer recognition before the crowd. That is why I study the supports. What is carrying the market? What is the support beam? What does that beam cost? How much of the public's confidence depends on the beam? How long can the beam realistically remain strong? Those are better questions than why it has not crashed yet. That question is for spectators. The serious investor asks about weight, structure, and support. This is also why I dislike the phrase new normal. The phrase appears whenever people become too comfortable inside a stretched arrangement. They say maybe valuations do not matter like they used to. Maybe deficits can continue without consequence. Maybe inflation can keep flattering nominal growth forever. Maybe consumers can keep spending through strain. Maybe policy can keep rescuing things. Every bubble creates its own language for why the old limits are obsolete. Then the limits return anyway. That is why I trust first principles more than contemporary slogans. Price cash flow debt, demand quality, policy dependence, confidence. Those things do not become irrelevant because the crowd is tired of hearing about them. If anything, they matter most when the crowd is tired of hearing about them. That is usually the sign that delay has already damaged judgment. I think the best way to describe this market is simple. It is not standing because the danger was overblown. It is standing because the supports were stronger and more distortionary than the public first realized. That is not a reason to admire the structure. It is a reason to respect the cost of the support and to understand that when the support weakens, the adjustment can be much faster than the crowd expects. This is why I remain sober. Sober does not mean panicked. Sober means unwilling to confuse delayed punishment with repaired weakness. Sober means unwilling to let recent price action rewrite valuation discipline. Sober means unwilling to let policy memory become a substitute for analysis. Sober means understanding that one of the great hidden costs of the delay is that it teaches investors to trust the wrong things. And if investors have learned the wrong lessons for long enough, the eventual repricing is not just financial. It is educational. The market teaches the crowd again what it refused to learn voluntarily. I would rather learn it in advance. That is why I stay cautious. That is why I do not trust this calm man. That is why I think the delay has made this market more dangerous, not less. There is one final reason I think this cycle is so risky. The longer the market survives on layered support, the more it invites people to build life decisions around inflated assumptions. Households spend more, funds take more risk, businesses allocate more aggressively, and policymakers feel less urgency to restore real discipline because the tape is still holding together. That means the delay is not only financial, it changes behavior throughout the system. This is how the eventual adjustment spreads beyond stocks. The stock market is only the loudest messenger. The deeper issue is that delayed recognition allows weak assumptions to multiply in private behavior, public policy, and portfolio positioning all at the same time. That is why I think the safest mind in an unsafe market is not the most confident one. It is the one that keeps asking what still has to remain true for current prices to make sense. If too many expensive supports need to remain true at once, then the structure is not robust. It is merely still standing. Those are not the same thing. And I know which one I am willing to trust with my capital. There is another reason I say the market has trained people to trust irrationality. It has rewarded intellectual laziness. Investors have stopped demanding clean explanations for why prices deserve to be this high. They no longer require a sturdy bridge between valuation and reality. They only require that the bridge still appears passable today. That is a lower standard of thought, and lower standards of thought are usually one of the last luxuries a bubble can afford before it starts to lose altitude. The public also forgets that expensive markets often become very dependent on narrative hierarchy. One story sits above the others and keeps the whole structure coherent. Right now that story is some mix of technological salvation, policy support, resilient consumers, and the old reflex that weakness will always bring rescue quickly enough to keep the machine from seizing. I do not reject every element of that story. I reject the way the market is pricing the story as if it contains almost no room for disappointment. That is what makes me cautious, because markets do not need the story to become false in every detail. They only need investors to stop loving it as much. Once that happens, the price investors are willing to pay for the same facts can fall very quickly. That is why overvaluation is a vulnerability, not a timetable. It tells you how much sentiment matters. And sentiment, once elevated enough, can become much more fragile than people assume. This is also why I am suspicious of comforting phrases like this: time the economy is different. Maybe it is different in some respects. The debt still matters. The consumer still matters. The labor market is still a lagging indicator. Policy still has limits. Valuation still matters, even when people grow bored of hearing that it matters. The market may find a temporary way around arithmetic. It does not repeal arithmetic. That is the lesson investors, keep trying to forget in every major cycle. The reason they keep forgetting it is simple. A market that survives long enough against the odds becomes emotionally persuasive. People start treating endurance as wisdom. They think the market must know something. I think the market often knows only that enough support is still present to postpone a repricing. That is not the same thing as wisdom. It is certainly not the same thing as permanence. The longer investors rely on endurance as proof, the more abrupt the emotional reversal becomes once endurance stops being enough. That is why a delayed break can feel morally offensive to the crowd. They begin to feel that the market somehow betrayed them by finally behaving according to rules they had spent months learning to ignore. Nothing was betrayed. The crowd was simply trained badly by delay. This is why I keep coming back to memory. Memory formed inside a distorted environment can become an enemy. If your memory says markets always recover quickly, every decline looks temporary. If your memory says deficits always support demand, every fiscal excess looks manageable. If your memory says high valuations can always become more reasonable later, you stop respecting price. That kind of memory feels experienced. Often it is just recency wearing the costume of wisdom. I want a different kind of memory. I want memory tied to structure. I want memory tied to valuation, debt, policy limits, consumer balance sheets, and the mechanical role of confidence. That memory is much less comforting. It is also much more useful when conditions finally tighten. This is why I do not join celebrations in a market like this, simply because the tape is calm. Calm is not the same as soundness. A market can be calm because the supports are still functioning. The question is whether those supports deserve the confidence being placed on them. I think that question is getting harder, not easier, which is exactly why the public has become too comfortable asking easier questions. Instead, the easiest question is, why has it not crashed yet? The better question is what is still preventing it from correcting. The best question is what kind of loss becomes possible if those supports weaken in combination rather than in isolation. That is how I would urge any serious investor to think. Now, not in slogans, not in moods, in interacting pressures. Because the danger here is not simply high valuation. It is high valuation resting on a crowd that has become emotionally loyal to delay. That makes the structure much more vulnerable than it looks on the surface. I do not know when confidence will finally break. I do know that the market is asking for too much confidence relative to the quality of the supports beneath it. That is enough to make me careful, and care in a cycle like this is much more valuable than excitement. There is also a practical reason I prefer caution now. When a market is this dependent on confidence, mistakes in position sizing become much more expensive. A man can be directionally right and still lose badly if he lets enthusiasm determine the size of his bet. That is why I care about sobriety so much. Sobriety is not a mood. It is a position, management tool. It stops people from turning a late cycle illusion into a life-changing wound. That is the advantage I want. Not applause for being early, just the ability to remain clear while the crowd is still borrowing comfort from a structure that was never as sturdy as it looked. I think investors also forget that expensive markets rewrite standards. A valuation that would have looked absurd in a cleaner cycle begins to feel ordinary after enough months of upward drift. That emotional normalization is one of the great hidden dangers of delay. It lowers the public's threshold for caution. Once the threshold is lowered, almost every additional step into excess feels smaller than it really is. That is why late-stage discipline always looks lonely. The crowd standard has already moved. A disciplined investor keeps the old standard of arithmetic, even while the public is busy inventing a new standard of comfort. That difference may not feel rewarding in the short run. It becomes very rewarding when confidence finally stops carrying what fundamentals no longer can. That is the point where discipline cashes in, not because it predicted the exact day, but because it refused to be retrained by an irrational environment. That, to me, is one of the most valuable habits in all of investing. The ability to remember what still matters after the market has spent months trying to convince you that it does not. A market can delay pain. It cannot abolish price, debt, and structure forever. The crowd can forget that for a while. I do not intend to.